The Retirement Cafe podcast, the 9 accelerators for a successful retirement. Asset allocation. Hello and welcome to another episode of the Retirement Cafe podcast with me, your host, Justin King. If you're thinking about your retirement or already retired, you're in the right place. My aim is to help you plan for and live a successful and meaningful retirement. Retirement is far more than just a financial event. It's a significant life event, a major transition, which will bring with it new challenges and opportunities. So each episode contains tips, information, and inspiration to help you feel more informed and confident about your retirement. I hope you enjoyed today's episode. Hello and welcome to my podcast. This week we return to our series on the 9 accelerators for a successful retirement. This is the 5th episode. It's all about asset allocation. If you've missed the first 4 episodes, check out the show notes for this episode on our website, theretirementcafe.co.uk, or on your preferred podcast player where you'll find links directly to each episode. If you've been following this series, you'll know that when I'm not recording podcasts or creating videos about retirement, I run a retirement planning business, MFP Wealth Management. We specialize in helping people retire successfully. In fact, that's all we do. We just help people plan for their retirement. Over the years, we've developed a framework for what needs to be addressed for you to be able to retire with confidence, clarity, and choice about how you spend your retirement. We call this framework our Retirement Success Program, and it contains 9 accelerators. These are the areas of planning we consider when helping our clients plan for that next stage of life. So far, I've discussed life priorities, creating a lifetime financial forecast, minimizing lifetime tax, and what makes a well-crafted investment. My wife, Kathy, is back with me again for this latest episode as we delve into asset allocation. Welcome back to the podcast, Kathy.
Right, so we're talking about asset allocation today. And the first thing, I think, big picture, what do you mean by assets in the context of asset allocation? What are the assets you're talking about?
So when you get to retirement, obviously hopefully you've accrued enough resources to retire on. Mm-hmm. And we often think about, have we got enough on a pension, or have we got a buy-to-let, or what have you. So in essence, the assets would be, the things that we own that we can use to provide an income in retirement. We give up work. If we do give up work, of course, what assets have we got to allow us to continue to be able to be financially independent?
Okay, so that could be a property, or it could be cash, or it could be investment, or it could be...
And that's where we kind of start, you're absolutely right, we started classifying those, as you just did there. We started classifying them into certain things. So property. Now, you may own your own property, and you may think, well, I might downsize it, I might use it for equity release. There could be lots of things for your own property. Often people don't want to do anything with their own property because it's their castle, their home. So that is an asset, and a class of asset that is, of course, is your property. It's property. Yeah. And property could be, you could own a commercial building, you could own some flats, you could own some residential property that you let out. It could be a holiday home. So the property is the asset, I suppose, the asset class. But then within that, there are lots of individual elements to it. Okay. And that's repeated cash. There's cash deposits for just in the building society, the bank, national savings. You could lend money to the UK Treasury on another asset class, which is near a proxy for cash, which is Treasury bonds, gilts, when you're lending money to the government. So that's an asset class as well, gilts. And then there's something else near that, fixed income, which is again, fixed income could be corporate debt. So it could be, I don't know, let's say Vodafone want to expand into a market, or they need to build something new and they want to borrow some money. They would go to the stock market and issue a corporate bond. And then they would also guarantee to pay an income an interest payment for that money that you've invested with
So
them.
that's a fixed guaranteed income you
Well,
get from. Have I asked too complex a question there?
yeah,
A bit of a can of worms.
Well, it is a little bit, but fixed income investments receive a coupon. In essence, it's an interest payment for the money that they've borrowed.
Okay.
So obviously, if you're a good company like, if you were, the rating agencies rate companies on how good they would be to pay our debts. So to give you, just go into this a little bit deeper because I think it is quite interesting. But if you were, let's say that there was a chap walking past the street now, and he popped in and said, "Can I borrow £100?" and you didn't know him.
Yeah.
And you were in the money lending business, you would probably go, well, maybe, but how long do you want to borrow it for? And also, tell me a little bit about yourself.
Yeah.
And if you then thought he was a good credit risk, I don't know this, but let's say you did view Vodafone as a good credit risk, you'd have to pay them, they would probably be paying slightly less interest than a company that was known to be on the rocks.
Okay.
Because they'd have to pay a higher interest rate because they're not viewed as creditworthy. And then also the length of time someone borrows the money. So the chap who's walked past and says, "I'll pop back in 10 minutes' time and give you the money," comparable to popping back in a year's time, you would view that with a different philosophy or a risk analysis.
Okay, great. So that's fixed income.
Fixed
we're talking
income.
about as another asset class.
Yeah.
So then when it comes to kind of broadly stocks and shares investing, what have you got there with regards to asset classes? I mean, are they all just equities? Is that an asset class or is it a bit more complicated than that?
No, it is. No. It is an asset class. And shares in companies, which is really where we do a lot of our work for our clients. This is the investment piece that matches the financial plan. This is the engine behind it. And, I'm a big equity fan. And if you look at the broad stock market, and there's an index called the MSCI World Stock Market Index. And the idea is that all the companies quoted on the stock exchange throughout the world are constituents or make up this index. So those are companies of the world listed on stock exchanges. So we've heard of the S&P 500, the FTSE 100, the FTSE All Share, the FTSE 250. There's lots of markets throughout the world where companies choose to list.
Yeah.
Those are equities, often called shares or stocks, but it's in essence it's the same thing.
Okay, and that's an asset class in itself.
Yes.
Yeah. Okay. So I guess what we're talking about is asset allocation. So we've kind of understood there's lots of different types of assets, and then there's asset classes, kind of groups of assets, if you like, and then asset allocation. So what's that all about?
Well, your asset allocation is pretty much driven by first of all your financial plan. There's a whole heap of difference between if I've got a pile of cash on the desk now in front of me, okay, a big wad of £50 notes. That's if I need to go and buy something today, I need to pop down to Sainsbury's and buy something. I've got the cash, haven't I? Whereas if I've got 100, let's say I've got a big, the similar amount of money, but in a property. I don't believe I can take that to Sainsbury's.
Not quite so easy.
Because they're just going to go, no, you need to turn that into cash, first of all, which there becomes the problem. So we've then got to really understand what's the cash flow need for a client and when can the assets that we've got be turned into cash? Because that's what we need. Cash is there to be spent, isn't it? We've got to have it at the right time. And also, our expected return of cash is much less than our expected return of equities or property or commodities, things that could grow in value.
Yeah.
And also go down in value, of course. But historically, we've seen assets grow, real assets such as equities grow in line with inflation or way above inflation over the long term. So cash is really for our immediate needs. And we have a philosophy here at MFP. We always like to have a cash amount of up to 5 years worth of income. Now, we would take into account guaranteed income coming in, or state pensions, or income from other sources. Could be rental income coming in, that type of thing. But we like to make sure that a client, whatever happens to them in the markets, that they've got enough cash coming in for 4 to 5 years.
So they don't have to be forced sellers.
Absolutely. Yeah. Because, of course, assets, the way you've asset allocated can be volatile. Mm-hmm. And depending on the financial advisor, depends also, I think, on also the assets that get invested. Because clients come to us for advice, of course. Yeah. And they're going, okay, so you've done the financial plan. That's fantastic. It looks beautiful. I can see it spreading out until I'm 100. You've put in these factors of inflation and growth rates, et cetera, but actually I now need to fund the plan. Where shall I invest? Well, okay, so then we've got to look at it. Okay, so what income's coming in? So therefore, what can we do? If you look at the long-term return of the world stock markets, in fact, the data in the UK since about 1956, just the market itself has returned over 11% a year. And then if you look at different parts of the market, value and small companies, parts again of the quoted share markets, and value and small are again different definitions of smaller companies and what we call value companies on something called a book to market basis. But they've actually given a higher return over the long term. Higher return often comes with more volatility, but volatility in the world stock markets has generally been temporary declines and permanent advances.
Right.
So if you were taking your pound, over a 30-year retirement, if you had inflation at 3%, you'd need, if you had a pound you were taking to Sainsbury's, or let's say it would cost you £100 to go to Sainsbury's this week, in 30 years' time, you'd need about £240, £244 to buy the same basket of goods.
Yeah, that's quite shocking, isn't it? The impact of inflation. It's quite astounding when you think of it that way.
And this is kind of why human beings are we're scared of investing. Because, we've spent this is my philosophy on this, but we've spent millions of years evolving. And the one thing that has allowed us to evolve is because we have been very good at getting scared. We are full of fear. There's a rustle over there. It could be a lion. Now, shall I just chill out and it may not be? Or shall I get out of Dodge and and keep myself safe and my family safe and my tribe or whoever? Well, safety, the little amygdala part of our brain that keeps us safe and goes, oh, be frightened, run away, has done very well for us.
Yeah.
So there's a philosophy, or there's a thought process as a human investor that if I leave my money in the bank, it's safe. And I want to be safe. Of course I want to be safe. That's the place to be. But of course, is it? Because we've got financial services compensation scheme protections and all these types of things. But actually, if it's been eroded by £3, if your £100 is in the bank this year, and let's just imagine, I can't believe it could happen, but let's just imagine that there were some bank accounts out there that are paying 0%. Let's just imagine, in a crazy world, 0%. So this makes the maths easy, which, I need the maths to be easy. But if you've got 3% inflation, your money's worth £97 next year. But no one tells you. This is the kind of nuts thing where we provide all these illustrations and projections and costs and charges and all the rest of it on financial products or investments. But no one ever tells the man or woman who's got money in the bank that, the £100 you've got with us this year, madam, it's worth 97 next year. And then the following year it's worth 94, and the following year, So no one actually tells them that. And they don't want to get into investments because, of course, they're risky. And we've had a million years protecting ourselves from risk.
Yeah.
So, human psychology is we're actually a failed investor. And even when we do get invested, when the market temporarily declines, that it's done many, many times. I mean, the average within year decline in the world stock markets is kind of 14-15%.
Right.
Average, normal.
So
that's a normal year.
During 1 year, it'll go down. The markets will drop 14%, but
the long-term return is north of 11%.
Okay.
So
that shows it's pretty volatile.
It's temporary volatility, and then it marches forward. And again, this is just statistics, so it doesn't give any idea of what will happen in the future. But 4 out of 5 years, or 1 out of 5 years, we see a 30% decline.
Mm-hmm. Well, like last year.
Absolutely.
Start of the pandemic.
Absolutely. And then we've had credit. In my working life, I've had the '87 crash. I've had the .com bubble. I've had the credit crunch.
Yep.
Now the pandemic. It's kind of norm. I've shown my age now, but 30 years of investing, that's what I've suffered. But if you can suffer it, you get that long-term return. And that allows you to grow your money, not only with inflation, but historically north of inflation. Double what inflation's done. Well, that makes a significant difference to your lifestyle in retirement and your family's lifestyle in retirement, and maybe even the generations to come.
So you sound like you're very much a proponent of obviously investing. So we might have gone a little bit off on a tangent in terms of, we were talking about asset allocation, weren't we? So the point being, there's a role for investing.
There is a role for investing and choosing different assets. So for argument's sake, I was talking to a client earlier, and they've got 3 buy-to-lets, or she's got 3 buy-to-let properties, and she's going to cash in 1 next year, 1 in 4 or 5 years' time, another 1 4 or 5 years' time. And this will provide the injection of capital. And what it's also allowing her to do is to leave her investment portfolio to keep growing. She's realised that over the longer term, as she gets older, she doesn't want to be running a business of properties. Yeah. And she quite likes us just managing her pension portfolio, because that's just growing long term without any hassle for her. And therefore, so she has got asset allocation into property, won't sell her home, of course. She'll have exposure to property, but the rest of it will be in global equities with a smaller cap and a value cap bias, which is the way we manage money to get hopefully that expected slightly higher return.
And then finally the cash element, the readily accessible.
And absolutely, she'd got significant cash, 5 years with cash. We worked out they could buy a new car. We worked out that there was money in case there was a medical emergency. There was also another buffer for just the buffer that we haven't thought about. So there was that's where I look at it. So how can we really be robust? And Richard Thaler, who won a Nobel Prize for economics, he wrote a book, I think it's called Misbehaving. Right. He says, and I absolutely agree with this, but he says the pain of loss is twice as bad as the pleasure of gain. Yeah. So therefore, when it comes to money, naturally we don't want to get invested in things. Except, of course, it depends on your philosophy. That we see at the moment. Is cryptocurrency an asset class? Well, I don't know, but it's somewhere people are investing, and they're kind of investing because they're looking. To me, it's speculative investment. It isn't investing; it's speculation. 3:30 at Haydock. England to win the Euros. Whoever to win the tennis. It's a gamble that this thing is going to work, and. Are you that type of investor? If you are, why do you need to be? If you want to build long-term wealth, look at the asset classes that have performed. Work out your financial plan as we do, and then allocate your assets, your cash, your availability, your human capital into those things. I don't think you need to go into crypto, in my view. I don't think you need, you don't even need to get into the kind of, if someone tells you that they know some information that the market doesn't know, I don't think you really need to get into the kind of the managed money aspect that people who do all the allocation for you. You can go off to, I won't name an insurance company, but any of the big insurance companies, and they'll say, yes, if you look in their lists, they will have a managed portfolio. Mm-hmm. You kind of wonder who it's managed for, how it's managed. How do they know what you want? How do they know how that's going to fit?
So what they mean by managed portfolio is they do all your asset allocation for you, but without having a conversation with you about understanding the bigger picture.
Absolutely. And I suppose some financial advisors or clients directly, especially if they're running a large corporate pension scheme, when you were in the large corporations, you were given a list of funds, weren't you? Yes. And you just had to choose one. And probably no one really gave you much guidance about which one had a chance of.
You pick the one in the middle, don't you?
You do. And then some of them have this horrible thing where they do this de-risking. They move you as you get closer to retirement.
Mine does that.
and it moves you out of equities into fixed income. Yeah. The closer and closer you get to your retirement age that you arbitrarily picked when you were 22. Yes. I mean, this idea that you knew when you were going to retire. And that, of course, when you got to retirement, that you didn't have 30 years more ahead of you. So the whole thing's nuts. What we need to do is look at the success. The bit that we do is look at someone's cash flow and then allocate these individual asset classes into that. And we just look at what's worked in the past. Yeah. So I don't know about crypto. It didn't work in the past. .coms didn't work in the past. Would Warren Buffett buy it? Is what I want to, run that test over it. Would he? I'm not saying he gets it right all the time, but I just
pretty
it's pretty successful. I mean, I don't know. He's not buying crypto, to be honest, but I just think that actually buying. As in our portfolios, 11,000 different companies, well-run companies on the world stock exchanges, historically has done all right, and those asset classes have returned over and above inflation.
So the thing for me that has come through about this, I thought when we were going to talk about asset allocation, we were just going to talk about investing, but actually it's a much bigger picture, isn't it? I thought it was going to be about the different types of investments, but it's not. It's go right back up to the global level, isn't it? Of everything that you own.
It is.
So whether this question is relevant, but once you have allocated your assets, kind of theoretically, how do you actually implement an asset allocation plan? How do you kind of put that into force?
So here at MFP, we, as I say, it's all driven by that financial plan. So what do we need each year? And where are those income sources going to come from? What do we have? Different people have a different reserve as well. They'll want, some people will, we do have a client, don't we? We know £1 million in cash. That's what they need.
To feel secure.
Yeah. And I get that. That's fine. It's what's your number that delivers. These clients are very smart. They know exactly what they're doing. Mm-hmm. And they understand the ravages of inflation and they're happy with that. But they balance that out with other capital allocated into different things. So they've got money in a company that generates profits. Mm-hmm. Great. But they realise the risk attached with that as well. In fact, they're always talking about, what happens if it goes wrong? So they're very aware. And then they've got money with us, which we've allocated into a global equity portfolio. Low cost, rebalanced, kind of thoughtful, evidence-based investment strategy. Mm-hmm. So that's really how we do it. I think, how would people just listening to this do it themselves?
I presume you've got to start by creating a financial plan, haven't you?
Yeah, the plan drives everything. Yeah. It really doesn't drive...
What do you need when? And therefore, where will you take that from? And how will you allocate all your assets in the interim? And
of course, a few years ago, this was a lot easier, right? Because the state and your company looked after you.
Right, okay.
Well, the state does a certain extent. I mean, the state, two state pensions now. It's a significant, we've covered state pensions, £18,000 a year coming in on state pensions for a couple. I mean, it's marvellous. And it's got this inflation linking attached to it as well, the triple lock. And but if you were in a nice defined benefit pension scheme or a final salary pension scheme being the same things, you were also, you did 40 years working for, it still happens in the NHS and the local authority and the teachers and all this type of thing. But if you were in, if you were in a large corporation, they gave you a nice defined benefit pension scheme. Mm-hmm. We've got plenty of clients with those, haven't we?
Yeah.
Well, because they are pretty sure that that's secure income in their retirement, they can then be much freer on the rest of their money if that's providing what they need.
Yes.
And so this is where it kind of molds in. And so that's where I'd start. If I was trying to do this myself, I'd say, right, okay, so start with an Excel spreadsheet or, A4 sheet of paper. What income do I know I've got coming in?
What's guaranteed?
Yeah. As much as we believe that the British government will always continue to pay pensions, or our company pension scheme will continue to pay, or what have you, or the retirement annuity contract that we bought would continue to pay. But what's our guaranteed income? Then we might get rental income. Have we got that coming in? If we're not, think about what happens if one of you dies, if you're a couple. That's significant, because all of a sudden you've lost one of the state pensions. You may be only on 50% of your spouse's defined benefit scheme. And then go, right, okay, so what else? You should only really invest if there's a need to invest, I suppose. And generally for most people, as I say, £1, 30 years later, you need £2.43. There's a reason to invest to keep in pace with inflation. Even if we just match inflation, you've got enough money, I need it to match inflation. And then for a lot of our clients, they would like to leave some type of legacy. Even if that legacy is not children, but they'd like to leave the world a better place, and that is a gift of their estate to a charity, to whoever. So so it's just trying to create that plan and matching the longer term assets that we know will be volatile, so you don't want to be cashing in at the wrong time. It's the only thing we don't buy which is on sale.
What's that?
Shares.
Shares.
If you go to the supermarket today,
Yes.
let's say a can of tuna. We don't really eat a lot of tuna, but let's say it was let's say it was 2 for 1, and they were a pound a go. So you got 50p a go. And the following week you went in and they say, it's discounted to 25p a can. You'd buy loads. You'd fill your basket because you'd go, that's a great deal. Know the deal. So we all do that. We're wired like that. We're wired to see a good deal. So when the headlines in the papers come on the next time that 30% wiped off the stock market, that billions wiped off the stock market, do we all run out and invest?
No, we do the opposite.
Because we're driven by fear. Yeah. We're failed investors. It's the only thing when we put a Amazon Prime Day sale on. It's whatever Friday. What is it they call it? I don't know.
Oh, the Black Friday. Yeah.
It's a Black Friday deal, right? 30% off all the stock market prices, because then the thing historically is compounded twice inflation over the long term, that we don't run out and buy. I mean, it's kind of nuts.
I don't think people think of it that way, though, do they?
No.
Most people.
Well, and hence, this is what we're brought to the world for. I always think 20% of the time we're paid for doing the planning, because it's significant. You've got to know about the tax. You've got all the things we've covered covering in the accelerators. You've got to know all of that stuff. And then 80% of the time, it's to get the right behavior from the client. It's allowing them to move into a period. I mean, how many times do our clients say to us, oh, it's really nice to see that cash flow. I now feel confident that things will work. Yeah. However much I put out there, look, I don't know what the investment rate return is. I don't know what inflation is going to be. I don't know when you're going to die. I don't know what the tax rates of the future will be. But if you come back to, I've said this many times, I've been a sailor. If you were sailing from here to New York, I don't know what the weather will be for the 3 weeks it'll take me. I don't know exactly. I don't know whether my kit will break or what the wind will change or the tides or what have you. But I still kind of know it's west. So I've got a plan that if I go west, that I'm going to hit the United States of America, and therefore, and then I adjust my plan as we go through, and we would adjust asset allocations as we go through.
So once you've set that up, how do you make sure it remains allocated in the way that you initially set that out to be?
Well, of course, the first question is has your plan changed?
Yes.
And actually, for most people, it does. Things, their health changes during the year. their children's lives changes, their parents' lives change, their income changes, the tax rates shift. So we are then doing that reassessment and going, right, okay, so we're writing now, going back to my sailing analogy, right, ship's log, this is where we are, this is now our headed course, this is what we know. Mm-hmm. And, if I'd have said 10 years ago that we're going to have base rates at 0.25, people are just, what? When I started in this world of financial services, my mortgage was at 12% or 13%. I mean, if you told 20-year-olds that today, they'd have heart attacks. So the whole world continued to shift, and therefore you need to continue to reappraise it. New information allows you to reconsider your asset allocation and your financial plan, or financial plan probably firstly, and then your asset allocation.
So is that once a year or more frequently than that?
We do that. We talked to clients a huge amount last year when the market was falling, and I think that's the point where we can still instill confidence and go, it's going to be okay. Has anything changed? Yeah, my stocks are down 30%. But has the financial plan changed?
Yes.
Because remember, we had 5 years worth of cash. Mm-hmm. No, my financial plan hasn't changed. So have we lost any money until we've sold? No. Therefore, can we maintain our course, Captain? Mm-hmm. Yes.
Okay, great. Good stuff. So, is there anything I've not asked you about asset allocation? Because we've talked around a whole host of things to do with assets and asset allocation. Is there anything we've not discussed?
Well, there are plenty of other things. There's commodities we haven't talked about. Okay. Gold, oil. I was only talking to someone this week. Client came in for a review. Was really happy with their portfolio. They'd done very well in the last 12 months. In fact, ever since they've been with us. And he says, my brother got into oil last year. Mm-hmm. And I said, well, how's that gone for him? And he's like, it hasn't gone well at all, but you can go and buy particular gold, silver, whatever it may be. You can buy different commodities, which would be, the asset. The class there would be commodities. Okay. So, so we talked about Treasury, lending money to the government, generally viewed safely, UK government, US government, but of course, I don't know about governments across the world, but I'm sure there are some governments that you wouldn't be wanting to lend money to.
There'd be a few that would spring to mind, would be top of my list.
So again, you're kind of risk assessing them on the return. They'd probably have to pay a much higher return to get you to lend the money. So, therefore, in corporate bonds, again, I kind of look at it and go, why do I want to lend money to a company when I can actually buy their shares? That's my view. At the end, the long-term data suggests that you have historically had a better return from equity markets than you have from the bond fixed income markets. So, commodities, property, equities, different types of equities.
Cash, fixed income.
No, I think
they're the main ones.
They are the main classes. I don't think I've missed anything there. No.
Good stuff. Okay. Any final comments?
I'm sure people will let me know if I...
Yeah. Well, please do. Comment. Send us an email. hello@theretirementcafe.co.uk. Just let us know if we've missed anything, and Justin will answer.
Try and answer.
Try and answer. Okay.
Good.
Great. Good stuff. Thanks for that. I think that probably just about wraps up asset allocation.
Fantastic. What's next? Do you know?
No.
No. Okay.
Well, we're on number 5.
Number 5, the 6th accelerator. Stay tuned for the 6th accelerator.
I think it might be care planning.
Very important care planning.
Care planning.
Something that we've
care planning.
Something we've had very personal experience of. So,
so I think that might be the next one.
Great.
So look forward to that one soon.
Look forward to that.
Okay.
Thank you to Kathy for helping me explore the fundamentals of asset allocation today. I hope you found our conversation helpful. If any questions have popped up for you as you've listened, or if you'd like a second opinion on your investment plan, please don't hesitate to get in touch and I'll do my best to answer. You can reach me on email at hello@theretirementcafe.co.uk or via Twitter at JustinKingCFB. Check out the show notes for links of what we've discussed today, as well as the previous episodes in the 9 Accelerators series. I know that some of you prefer to watch my podcast conversation, so you'll find a video version of every episode on my YouTube channel, Justin King MFP, and a link in the show notes on our website. If you do watch on YouTube, please make sure you subscribe and hit the bell symbol to receive notifications every time we upload a new video, so that you never have to miss an episode. And as always, if you've enjoyed this podcast, please leave a review on Apple Podcasts to help more people like you find us, or share this episode with someone you feel may benefit. So until next time, this is Justin King helping you feel more informed in your retirement.